I need to tell you something that's going to make you angry, and once you understand it, you're going to see the entire financial system differently for years. I thought I understood how banks work. You deposit money, they keep it safe. They lend some of it out, they pay you interest. Simple. Right, wrong. That's not how it works at all. What banks actually do is so much more insidious than most people realize. And when I finally figured it out, I couldn't believe we all just accept this as normal. Here's the truth. Banks don't lend out your deposits. They don't take money from savers and give it to borrowers. That's not what's happening. What they actually do is create money out of thin air every time they make a loan. And they charge you interest on money that didn't exist until you asked to borrow it. I'm not exaggerating. I'm not oversimplifying. That's literally how the system works. And once you understand the mechanism, you're going to realize why banks are the most profitable businesses in history, why wealth inequality keeps growing, and why you can work your entire life and still struggle financially, while banks make billions doing essentially nothing. Let me show you exactly how it works. Think back to school. Remember what they taught you about banks? They said banks are intermediaries. They take deposits from people who want to save and lend that money to people who want to borrow. They're the middleman. They facilitate the flow of money through the economy. That sounds reasonable, right? You put $10,000 in your savings account. The bank takes that $10,000 and lends it to someone buying a car. They charge the borrower 6% interest and pay you 1% interest. They keep the 5% difference as profit for their service. That's what everyone thinks happens. That's what I thought happened. But here's the thing. That's not what happens. Not even close. When you deposit $10,000 in a bank, that money doesn't sit in a vault waiting to be lent out. When someone takes out a car loan, the bank doesn't pull money from your account or anyone else's account. They just create new money. They type numbers into a computer. That's it. They create a deposit out of nothing, and now that person has money to buy a car. Your $10,000 is still in your account. You can spend it whenever you want. But the bank also just created another $10,000 for the car loan. So now there's $20,000 in the system where there used to be $10,000. The bank didn't lend out your money. They created new money using your deposit as an excuse. And this isn't a conspiracy theory. This is admitted fact. Let me show you. In 2014, the Bank of England, one of the most prestigious central banks in the world, published a paper called Money Creation in the Modern Economy, and in that paper, they admitted something that contradicts everything most people believe about banking. Here's a direct quote. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. Read that again. Bank lending creates deposits. The loan comes first, the deposit comes second. When a bank makes a loan, they're not lending out existing money, they're creating new money. The paper goes on to say, in the modern economy, most money takes the form of bank deposits, but how those bank deposits are created is often misunderstood. The principal way is through commercial banks making loans. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. This is the Bank of England saying this, not some fringe economist, not some conspiracy theorist. The Central Bank of England openly admitting that banks create money when they make loans. And if you think that's just a UK thing, the Federal Reserve, the European Central Bank, the Bank of Japan, they all operate the same way. This is how the global banking system works. So, let me walk you through exactly what happens when you take out a loan. Because once you see the mechanism, you're going to understand why the system is so profitable for banks and so expensive for everyone else. Let's say you want to buy a house. You go to the bank and apply for a $300,000 mortgage. The bank looks at your credit, your income, your assets. They decide you're a good risk. They approve the loan. Now, here's what you think happens. You think the bank goes to their vault, or their reserves, or their depositors' accounts, and pulls out $300,000 to give to you. That's not what happens. Here's what actually happens. The bank opens a spreadsheet, they type $300,000 into your account. That's it. They just created $300,000 out of nothing. They didn't take it from anywhere. They didn't move it from another account. They just created it by typing numbers into a computer. Now, you have $300,000 in your account, you can buy the house. But here's the key part. That $300,000 didn't exist before. The bank created it the moment they approved your loan. And now, you owe the bank $300,000 plus interest. Let's say it's a 30-year mortgage at 6% interest. Over 30 years, you're going to pay back around $647,000. The bank created $300,000 out of thin air, you're paying back $647,000 in real money that you have to earn through your labor. The bank made $347,000 in interest on money they never had. Do you see why banks are so profitable? They're not lending out deposits. They're creating money out of nothing and charging interest on it. It's the most brilliant business model ever created, and it's completely legal. Now, you might be thinking, okay, but banks can't just create infinite money, right? There have to be some limits. And you're correct. There are limits, but they're not what you think. The limit isn't how much money depositors have put in the bank. Remember, banks don't lend deposits. The limit is something called the reserve requirement. In the US, banks are required to hold reserves equal to a certain percentage of their deposits. For most of history, that number was around 10%. So here's how it works. If you deposit $1,000 in a bank, they're required to hold $100 in reserve. The other $900, they can use that as a basis to create new money through loans. But remember, they're not lending out your $900. They're using it as an excuse to create new money. So they make a $900 loan. They create $900 out of thin air. The borrower gets that $900 and spends it. That $900 gets deposited in another bank. Now that second bank has a $900 deposit. They keep $90 in reserve and use the other $810 to make another loan. They create $810 out of thin air. That $810 gets spent and deposited. The next bank keeps $81 in reserve and creates $729. On and on it goes. From your original $1,000 deposit, the banking system can create about $9,000 in new money. That's called the money multiplier effect. But here's the really crazy part. In March 2020, the Federal Reserve reduced the reserve requirement to 0.0. That means banks can now create unlimited money with no reserves required at all. The only limit now is whether they think the borrower can pay it back. That's it. So, when you ask, what stops banks from creating infinite money? The answer is not much. Now, let me show you the darkest part of this system. The part that guarantees you can never get ahead. Remember, when banks create money through loans, they only create the principal. They create the $300,000 for your mortgage, but they don't create the interest. You owe $647,000 total, but only $300,000 was created. Where does the other $347,000 come from? It has to come from somewhere else in the economy, from someone else's loan, from someone else's money creation. But here's the problem. Everyone's loan is the same. Everyone borrowed principal, but owes principal plus interest. So the total amount owed in the system is always greater than the total amount of money that exists. It's mathematically impossible for everyone to pay back their loans. Think about it. If there's $1,000 in the economy and everyone collectively owes $1,100, someone has to default. There's not enough money in the system to pay everyone back. The only way to keep the system running is to create more loans, which creates more money, which creates more debt, which requires more loans. It's an infinite spiral. Debt has to keep growing forever, or the system collapses. And who benefits from this? The banks. They collect interest on money they created out of nothing, knowing full well that not everyone can pay it back. When people default, the bank sees the collateral, your house, your car, your business, real assets in exchange for money they created with the keystroke. It's the perfect scam. Now, let me show you how the central bank fits into this. You might be wondering, if banks can create money, why do they need the Federal Reserve? Good question. Here's why. Even though banks can create money, they still need to settle transactions with each other, and they need reserves to do that. Let us say you bank at Wells Fargo and you write a check to someone who banks at Chase. Wells Fargo has to transfer reserves to Chase to settle that transaction. Where do those reserves come from? The Federal Reserve. The Fed is the banker's bank. They hold the reserves that banks use to settle transactions. And here's where it gets interesting. The Federal Reserve can create limited reserves out of thin air, just like commercial banks create deposits. The Fed creates reserves. So, you've got commercial banks creating money out of nothing, and the central bank creating reserves out of nothing to back up the money the commercial banks created. It's money creation on top of money creation. And at every level, someone's collecting interest. When you take out a mortgage, you pay interest to the bank. When the bank needs reserves, they pay interest to the Fed. When the government needs money, they issue bonds and pay interest to whoever buys them, often the Fed. Interest payments flowing up the chain at every level, and all of it based on money that was created out of nothing. Let me show you who actually wins in this system. It's not you. Even though you can get a loan to buy a house or start a business, you're paying interest on money that didn't exist until you borrowed it. The winners are the people who understand how the system works and position themselves accordingly. First, the banks. Obviously, they create money, charge interest on it, and collect real assets when people default. It's the most profitable business model in history. Second, the asset holders. The people who own real estate, stocks, businesses, when banks create new money. That money flows into the economy and drives up asset prices if you already own assets. You get richer. Your house appreciates, your stock portfolio grows, your business value increases. But if you don't own assets, you just see prices go up. Rent gets more expensive. Houses become unaffordable. Everything costs more, but your wages don't keep up. That's the Cantillon effect again. The people closest to money creation get rich. Everyone else gets inflation. Third, the government. They get to borrow unlimited amounts of money because the central bank will always buy their bonds. They can run deficits forever because they never actually have to pay it back. They just refinance with new debt. And who pays for all this? You do. Through inflation, through higher prices, through stagnant wages, through a lifetime of debt payments. The system is designed to extract wealth from labor and transfer it to capital. You work. You earn money. You pay interest on loans. You pay higher prices due to inflation. Your purchasing power slowly erodes. Meanwhile, banks create money from nothing. Asset holders watch their wealth grow. And the government spends without constraint. This isn't capitalism. This isn't a free market. This is a rigged game. Here's what most people don't know. Banking didn't always work this way for most of human history. If you wanted to lend money, you actually had to have money to lend. If a bank wanted to make a $1,000 loan, they needed to have $1,000 in deposits or capital. That's called full reserve banking. You can only lend what you have. But over time, banks figured out they could lend more than they had. They realized most depositors don't withdraw all their money at once. so they could lend out more than their reserves and probably get away with it. That's how fractional reserve banking started. Lend out 90% of deposits, keep 10% in reserve. But even that had limits. You still couldn't lend more than deposits. The modern system, where banks create money out of nothing when they make loans, that's only about 50 years old in its current form. It really took off after 1971 when Nixon closed the gold window, and the dollar became pure fiat currency backed by nothing. One's money wasn't tied to gold anymore. There was no constraint on money creation. Banks could create as much as they wanted as long as central banks allowed it, and that's exactly what happened. The money supply exploded, debt exploded, asset prices exploded, and wealth inequality exploded. In 1970, the top 1% owned about 15% of all wealth in America. Today, they own over 30%. That's not because they work twice as hard. It's because they understand the system and position themselves on the receiving end of money creation. Let me bring this back to you personally, because this system is why you can't get ahead no matter how hard you work. You go to college, you take out student loans, the bank creates $50, zero out of thin air, and gives it to you. You owe $50,000 plus interest. You graduate and get a job, you're making $60,000 a year. But after taxes, student loan payments, rent, you're barely breaking even. You want to buy a house, you save for a down payment, but while you're saving, the bank is creating millions of new mortgages for other people, driving up housing prices. By the time you have enough for a down payment, houses cost 20% more. You finally buy a house for $100,000 mortgage. Over 30 years, you'll pay $800,000. The bank created for $100,000 with a keystroke. You're paying back $800. Zero with money you have to earn through your labor. Meanwhile, housing prices keep going up because banks keep creating more mortgage money. You feel like you're getting ahead because your house is worth more. But you're not. You still owe the bank. And everything else costs more too. You're on a treadmill, running as fast as you can, but not actually going anywhere. Because the system isn't designed for you to get ahead. It's designed to keep you in debt. Debt is profitable. Debt is controllable. Debt is the product. And as long as you're in debt, you have to keep working, keep earning, keep paying interest to the banks. Now, here's what you need to understand about where we are right now. This system requires infinite debt growth. As long as debt keeps growing, the system stays stable. But debt can't grow forever. Eventually, people can't afford to borrow more. Eventually, the interest payments become too large. Eventually, defaults start accelerating. And when that happens, the money supply starts to contract. Banks create less new money. Old debts get paid off or defaulted on. Money disappears from the system. That's called deflation. And it's catastrophic for a debt-based system. So what do central banks do? They panic. They lower interest rates to zero. They buy bonds to inject money into the system. They do whatever it takes to keep debt growing. We saw this in 2008. We saw it again in 2020. Each time, the central banks had to create more money than the time before. Each time, the debt grew larger. Each time, the problems got worse. And now, we're at the point where interest rates can't go any lower. Debt is at record levels, and the only tool left is to create more money. So that's what they're doing. Trillions in new money creation. Quantitative easing. Debt monetization. But here's the problem. When you create too much money, eventually people lose confidence in the currency. Inflation accelerates. Prices spiral out of control. That's the end game. Either deflation collapses the debt, or inflation destroys the currency. Both end with a reset. A new system, a new currency, and the largest wealth transfer in history. So what do you do with this information? First, understand that the system is designed to keep you in debt. Every advertisement, every easy payment plan, every low-interest offer is designed to get you to borrow. Resist it. Debt is the product they're selling. Don't buy it. Second, understand that cash is being debased. Every time banks create new money, your cash becomes worth less. Holding cash is holding a depreciating asset. Move into things that can't be created out of nothing. Hard assets, real estate, commodities, gold, Bitcoin. Third, understand the Cantillon effect. The people closest to money creation get rich. You can't get close to money creation, but you can position yourself like they do. Buy assets, own things that appreciate when money supply grows, stop trading your time for money, and start making money work for you. Fourth, educate yourself. The system relies on people not understanding how it works. Once you understand it, you can stop playing their game and start playing your own. The banks create money out of nothing. They charge interest on it. They collect real assets when you default, and they do it all with your permission because you don't understand what's actually happening. Now you understand. Let me give you the simple truth about how banking really works. Banks don't lend deposits. They create money out of thin air when they make loans. They charge you interest on money that didn't exist until you asked for it. The interest can never be fully paid because the interest money was never created. This guarantees perpetual debt, perpetual growth, and perpetual wealth extraction from labor to capital. The system benefits banks, asset holders, and governments. It extracts wealth from workers, savers, and anyone holding cash. It's not a free market. It's not fair. It's a rigged game. But once you understand the rules, you can at least play accordingly. You can minimize debt. You can buy assets. You can position yourself on the right side of money creation. Or you can keep playing the game they designed for you. Keep borrowing. Keep working. Keep paying interest on money they created with the keystroke. The choice is yours. But at least now you know how the system really works.